In this video, I'm going to be talking through why I personally don't use the Lifestrategy funds that Vanguard offers. The Lifestrategy funds are multi-asset funds. It is a fund that's made up of loads of different funds, and personally, I don't use the Lifestrategy funds. If you follow me at all, you know that I use the FTSE Global All Cap, and 100% of my money when it comes to my stocks and shares ISA with Vanguard is in the FTSE Global All Cap. So in this video, I'm going to be talking through why I personally don't use the Lifestrategy funds, and I know they're a popular choice. So before you dislike the video or anything like that, I will say I think they're a great product range, and I'm going to get into that more in a second, but I don't personally use them, and the main reason why is because I think the cons outweigh the pros for me personally, and I'm going to be coming onto that shortly. But as I mentioned a second ago, I think they're a great product range. It's certainly better to use the Lifestrategy funds than nothing.
Obviously.
They've been around now for more than 10 plus years. They brought fees down massively for UK investors. They offer global diversification. They also offer a split between bonds and stocks, so you haven't got to invest into multiple funds. There's the Lifestrategy 100, which is 100% stocks, all the way down to the Lifestrategy 20, which is 20% stocks, 80% bonds. They're generally a way to passively invest. You can set up an automatic payment and be done with it. It's almost one fund to do it all. It's an off-the-shelf product where everything is done for you, and as I said, you just need to set up an automatic payment and watch your wealth grow and compound over the years. But obviously, all of that sounds great, but personally, I don't use them, and I think because the cons outweigh the pros. But first of all, let me just go through the pros now. The first pro is that it's very simple. As I said, it's off the shelf. You click a button, set up an automatic investment, and that's all you really need to do. They're very beginner friendly. You haven't got to know anything about investing or allocations. You almost choose a level of stocks and bonds that you want, maybe 100% stocks, all the way down to 20% stocks, 80% bonds, and that's it. So based on your risk tolerance, you can set a sort of level of stocks and bonds, and then as you get older, you can then slowly change that probably more towards bonds. I think that's actually a huge pro, because if you do want to get a mixture of stocks and bonds, you normally need to use two different funds, and as the stock fund and bond fund inevitably sort of grow or contract, you'll then need to sort of rebalance your portfolio quarterly or annually. With the Lifestrategy fund, you can select the Lifestrategy 60, which is 60% stocks, 40% bonds, and that's literally it. It will automatically rebalance for you. So it makes your investments more automated, more passive, more hands-off, and you know you've got a stock and bond split in one fund rather than having two funds and having to do that manually.
Hey, that's pretty good.
The second pro is that they're big. They have a lot of assets under management, which shows that investors trust them, they like them, they think they're good funds. The third pro, as I mentioned already, they're globally diversified. Investing fees have come down massively over the years, and that's a lot due to Vanguard and this range of funds that they first started to offer over 10 years ago. Investing into one fund and being able to get global diversification is brilliant. But as we're going to see when we come to the cons, the diversification isn't necessarily weighted the best. The fourth pro is that they're ultimately low fee. The fee of the funds are 0.22%, which when it's an off-the-shelf product, you haven't got to do anything. You select one, the Lifestrategy 60, click invest. Paying a fee of 0.22 per year is very, very low. Even though fees are continuing to come down over the years, this is still a very low fee for a global portfolio. As I mentioned already, you can almost recreate these funds, these Lifestrategy funds, by using multiple other different funds. But then if you have 2, 3, 4 different funds, you're going to need to rebalance them every quarter, every year. And personally, I think for the sake of a few basis points of 0.05% when it comes to fees, I'd rather use less funds and not have to rebalance rather than using, say, 5 different funds and having to tweak them throughout the year and try and get the weightings right. I'd rather just let the fund do it itself for me.
Knowledge.
And finally, the fifth pro, as I mentioned at the start, and I'm probably going to mention again at the end, it's certainly better to use one of these Lifestrategy funds than nothing. Ultimately, by using one of these funds, you're going to be investing into a mixture of stocks and bonds, or maybe just stocks if you're using the LS100, and it's much better doing this than just keeping all your money in cash that's losing out due to inflation. But now, what you've been waiting for, the reason why I don't use the Lifestrategy funds, and that's ultimately because of the cons, so let's go through them now. The first con is that although it is a passive way to invest from our point of view, the investors, there's actually some active decisions that have gone into it. As I mentioned, these funds are made up of loads of other funds, and those funds, the weightings, have been chosen specifically by Vanguard. So there's been more of an active decision in those weightings. Of course, we're preaching long-term passive investing, but the fact is the funds that make up the Lifestrategy fund those percentages have been chosen by someone, which slightly goes against the passive investing approach where we just want to track the market based on whatever is performing good or bad, which gets me to point number 2. And because of the way they choose their allocations, there is a UK home bias. And this really is the big one for me, and I know it's a big reason why other people choose not to use them, because there's a UK home bias. And what that means is there is more allocated to UK stocks in the Lifestrategy funds than what UK stocks make up of the total global stock market. If we look at the Lifestrategy 100, which is 100% stocks, it is made up of 25% UK equities or UK stocks. If we look at a more weighted global fund like the FTSE Global All Cap or VWRL, the FTSE All World, there's only 4% UK stocks, because the UK makes up roughly 4% of the global stock market. And that's what I mean when those global funds, the All Cap and the All World, are more proportionally weighted. So the Lifestrategy 100 having a 25% UK equities holding is actually 6 times overweight UK stocks. Now that's not necessarily right or wrong, good or bad, it's just not in proportion to what UK stocks actually contribute to the global economy. Of course, this has been highlighted more in recent years because UK stocks have lagged behind the last decade US stocks. Of course, going forward, no one knows. If the UK stocks perform amazingly over the next 10 years, this is clearly going to be a good decision because there's more UK stocks, but it goes against that passive investing philosophy of being proportionally weighted with each country, sector and company. And ultimately, in rates of return with the Lifestrategy funds compared to more weighted funds, this has been shown over the last decade, where because it's underweight US stocks and overweight UK stocks, and US stocks have been the main driving force, particularly tech companies, over the last 10 years, that has then resulted in a discrepancy between the returns from the LS funds compared to other more globally weighted funds. If we look at the LS60, which is 60% stocks, 40% bonds, that still has 15% UK equities, so it's still 4 times overweight, and the total fund, including both equity and bonds, is 28% UK. So as you can see, there's a sort of a home bias even going down from the LS100 all the way down to the LS20. As I mentioned, it's not necessarily right or wrong, good or bad to be overweight UK stocks. For me personally, I'd rather be more accurately, proportionally weighted to which each country makes up the global economy, and that is ultimately the main reason why I use the FTSE Global All Cap.
But wait, there's more.
It is worth saying here though as a caveat, US stocks, even though they make up the bulk of the LS fund still, they make up the bulk of the All Cap, they make up the bulk of the global economy, they ultimately are dominated by a few companies, mainly the FANG stocks, companies like Apple, Facebook, Netflix, also companies like Microsoft and Nvidia have a huge weighting on US stocks. Because those stocks make up such a large portion of the US and of the global economy, those tiny little movements in the needle can result in huge impacts to the US. So it's worth noting that even though the US is the main global superpower when it comes to the stock market, a few companies really are the driving force behind that. I appreciate this is quite a long point, but to then tie into this, rather than looking at countries, to then look at sectors, the UK is also very underweight tech. If you look at the FTSE 100, it's only roughly 2% tech stocks compared to a more proportionally weighted index, a global index, which is around 22% tech stocks. Of course, this is mainly driven once again by the US, but it's worth noting by investing into the Lifestrategy 100, for example, you're going to be 25% UK stocks. As we now know, there's hardly any tech exposure in UK stocks, only 2% in the FTSE 100. So because there's this home bias towards UK stocks in the Lifestrategy funds, there's then also a bias towards certain industries depending on what industries are more dominant in the UK. And those industries, looking at Vanguard's website and the FTSE 100, are things more like consumer staples, financials, industrials. I guess less innovative industries compared to things like tech, which of course tech could be overvalued, no one really knows, but personally it seems more likely than not the tech is here to stay and will carry on growing. Now that was a long point and the main one, but the third point I'll touch on is bonds. Personally, I am only 24, I don't really have any need for bonds. Really, as people are going to be living longer than ever and having longer retirements than ever, your money needs to go further than ever. More of a more likely chance as you get older, you actually keep more of your money in equities because you need your money to grow to carry on living off of it. But yeah, as I said, ultimately, as I'm young, I don't need bonds, so I'd rather have 100% stocks, which then leads me to, as I want to be globally diversified, the LS100 or the FTSE Global All Cap, and I prefer the FTSE Global All Cap because it's more proportionally weighted. I'll actually throw up a more niche point just on the topic of bonds from a Motivator blog article. But if your fund is more than 60% invested in bonds and cash, it's like the LS20 and the LS40, that then counts as interest rather than dividends, and interest attracts higher levels of income tax. That's just something to be aware of that I thought I'd chuck in here. And that sort of wraps up this video. I've gone for a quick summary, the 5 pros, the 3 cons, and even though there are more pros in quantity, I think the cons outweigh the pros, and that's why, even though the LS funds, I will reiterate, are great, they're simple, easy, low fee, off the shelf, a great way to invest for a lot of people. I personally stick to the FTSE Global All Cap. I would say personally that if you want to keep your strategy simple and you want to have some bond exposure, maybe because you're more risk averse or because you're slightly older, this is a great way to go because you just need to select one fund and you'll have stocks and bonds. If you chose the All Cap, like I do, that is 100% stocks. So you'd also need a separate bond fund, which means your portfolio would be 2 funds, and then you'd have to rebalance throughout the year, which obviously is a bit more time consuming, a bit more faff. So they are good if you want a mixture of stocks and bonds in one fund. Although obviously, remember the pros we talked about it being overweight UK and that sort of thing. Ultimately though, as the closing comment, using the Lifestrategy funds is certainly better than doing nothing. It's certainly better using one of these funds than procrastinating and not starting, by keeping your money in cash the whole time, by not doing anything. So if you're struggling to do anything, I'm not a financial advisor, but it's much better to choose one of these funds and start investing than do absolutely nothing. So I will say that. Thank you very much for watching. I'll be interested to hear your thoughts in the comments below. Do you use the Lifestrategy funds? If so, why? If you disagree with any of the things that I've said, feel free to let me know. I'd happily chat with you in the comments. If you don't use them or agree with me, also let me know. Interested to hear if you have other pros and cons that I haven't mentioned. But thank you very much for watching, and I will see you in the next video.